we say don't fight the Fed, but how do you fight this bond market? How do you buy equities at record highs at higher valuation when there's $13 trillion of negative yielding debt now?
Well, yes. I mean, debt is an issue, but a lot of that debt is residing in Europe, given that their rates are essentially in negative territory. Germany being close to 30 basis points, negative 30 basis points. France hovering around zero. I think if you look at underlying U.S. economic growth, however, we are optimistic, and I think those yields, those negative debts, I think will have a lot of optimism attached to it once growth rates start to appear again in the underlying economy, as we expect longer term.
So you're optimistic about the economy overall. It appears that given the PE ratios, the equity markets are pretty optimistic as well. We'll put up a chart here actually that shows where we are on PE ratios. They're the highest they've been in a couple of years, although not as high as they were back in 2017. At what point do we get concerned that equities may be overbought, no matter how optimistic you are about the economy overall?
Well, at the moment, the S&P 500 is trading around 16 times next year's numbers. When inflation is around 0 to 2%, the PE ratios hover around 17 to 18 times. So the market is certainly not cheap at the moment, but it's not expensive either. But, even though we do have a more optimistic longer-term view, we do see there's volatility in the shorter run that could create some, potential opportunities for the investors to move into the market.
So where would those opportunities be? Because for the most part, the rally that we've seen over the last few weeks has really been about the defensive sectors that are quite expensive. So how do you balance those two things?
Sure. I think for the whole year, what we have been advocating is a balance between value and growth. So really concentrate on companies that have strong balance sheets, strong cash flow, strong management teams, and pricing power. When you have those companies in your portfolio, if you are slowing down, they'll be able to defend their market position. And in the growth times, they will be able to invest and prosper through that. So we specifically like technology on the growth side, and we like REITs on the more defensive side. For technology, it's really driven by structural growth rates. If you think about 5G, artificial intelligence, gaming, cloud, all of these structural trends are going to keep growth rates within technology, pretty solid. But of course, you have to be a lot more selective, given the valuations in technology are not exactly cheap either. So you really do have to be selective. On the defensive side, we like REITs. REITs do benefit from a macro perspective with the rates being lower, given they are a defensive sector. However, within REITs specifically, we like the data centers and we like housing-related REITs as well.
So, Linda, when you talk about value versus growth, people have been predicting that value would come back for some time. It really hasn't. I'll put a chart up that shows on the top level it's in large caps and the bottom level are small caps. For both of them, the top curve is the growth rather than the value. Are you thinking those may converge or come near one another, or are you saying just as a matter of diversification, you want to be in both?
Well, I think as a value manager, I've been waiting for value to outperform for a number of years now. However, I think what you need at this point, given the issues around trade and global growth, I think you want to be balanced. I think, but within balance, you want to be careful to have really strong companies in your portfolio. So we do like value. We are a value manager, but at the same time, value needs to have economic growth attached to it a little bit more. So, or stability of that economic growth. And we will get that once we start seeing the trade agreement signed. We come through this inventory correction that we're seeing right now, and towards the end of the year and into 2019, I think value is going to shine. There is absolutely no argument that value is cheaper than growth, but there is an issue of timing.
So that's a bet on a better outcome for trade, et cetera. But what about if we go with what the Fed talked about? If they wind up cutting, I know TD Securities is looking for six cuts, 3 this year, 3 next year. What kind of PE multiple do you put on an S&P if you're looking at something like anywhere between 2 and 6 rate cuts over the next 18 months?
Sure. So I think at the moment, even though the market is pricing in a rate cut, are they going to cut? Most likely. I think Fed went ahead and said everything other than we will cut, essentially those exact words. But in my opinion, the underlying economy doesn't necessarily need a rate cut. Should they cut? Probably no. You still have a lot of slack within the economy. The consumer, which is 70% of the U.S. economy, continues to remain strong. They're gainfully employed. They're getting pay increases. They have good savings rate, and their house prices are increasing. What is lacking at the moment is manufacturing, and manufacturing, I think, is more of a inventory slowdown. So I think those expectations for the Fed cut, if we see those, more of a balanced, manufacturing growth over the next couple of years, or next couple of quarters, I think that's going to come down considerably.